Hello and welcome to episode 387 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leakes. Damien, welcome back to the show. How are we doing?
I'm good after last week's break. Apologies, I lost my voice. I seem to these days, whenever I get some kind of cold, even if I don't feel particularly unwell, it seems to go to my voice. And by the middle part of last week, I was struggling and I'd recorded some videos on where interest rates would go for our YouTube channel. And I quickly squeezed that in because I knew my voice was going to disappear. And within hours, it was gone. And so I couldn't do the podcast. But of course, the team took over admirably and produced another great show. So I'm back this week to do the show. And we're going to do something a little bit different, actually. So where I normally do a podcast that's split into three key parts where I talk about different topics, it got me thinking, because you've not heard from me for a couple of weeks. In the office, we're talking about a lot of stuff that's going on. In the last month, we've had so much go on in the UK in terms of not just changes of prime ministers, but we're seemingly having an economic crisis at the same time. The world has shifted considerably. So we are not in the same world that we were just over a month ago even, and let alone if you go back 6 months or a year. And we've had the Bank of England intervene in bond markets. And so this is the sort of thing that we haven't seen since the financial crisis or the pandemic. So the world is different. And on reflecting about that and the things we're talking about in the office, you and I were talking, weren't we, Andy? And we were saying that I think people would like to hear this on the podcast. Listeners would want to know what we think about different things and how the world shifted and the things that I'm thinking about what's going on in savings, pensions, mortgages. And we really need to just put that on the show, even if it's a slightly different format to usual.
Yeah, I know we've always said here at Money to the Masses that the podcast is designed to be evergreen content and we don't really get involved in the now as such. But honestly, we can't ignore it. We're getting constant contact from people asking for our opinions on certain things right across the board. Obviously, it's a strange time right now. So it's the right thing to bring this to the podcast and just come up with a few discussion topics almost around those areas.
Yeah. So, of course, if you have any questions, do join the Money to the Masses Facebook group. So that community, you can ask questions, share your own experiences, and it's a friendly place. Go to facebook.com/groups/Money to the Masses. Of course, you can email into us, Damien at moneytothemasses.com, Andy at moneytothemasses.com, or any member of the team. If you just put their first name at moneytothemasses.com, you will get to them. But the Facebook group, you are likely to get a lot of different opinions as well. And there's a lot of good discussion that's going on our YouTube channel as well, below the various videos that I'm doing, because I do regular updates on where interest rates are going on YouTube. I don't put that on the podcast. So if you're interested, then go and look at our YouTube channel for the latest video that came out last week, because the market predictions have really shifted on where interest rates are going to be headed. And when I say interest rates, I'm talking about Bank of England base rate and therefore mortgage rates. So it's always good to get the emails from people, particularly where they've said they've taken action based upon what we talked about on the podcast, fixed their mortgage earlier on in the year or prepared for a world where they were building a cash buffer, all these kind of things. So what I'm going to do is break this down into really three areas, and that's savings, so savings accounts, pensions, and mortgages. Now, I could talk about lots of other things, but I'm going to just put it down to those three topics just to try and keep it succinct and hang it off there. So let's kick off with savings. So the world of savings has shifted significantly. And it was only the other day in the office where we update all these savings tables. If you didn't realize that, every week we update the best buy tables on the Money to the Masses website. Go onto the moneytothemasses.com. You'll see on the top navigation panel, you'll see best buys. Click on that drop down, you can go in and see the best savings rates, and they are the best saving rates on things like easy access accounts, fixed rate bonds, variable rate ISAs, junior cash ISAs, you name it, we cover the whole market. And I was surprised to see that on a fixed rate bond now, you can get between 4 and 4.5% a year in interest. So if you lock your money away for 1 year, you can get 4% and you can get up to 4.5%. So those rates are continually rising. And Andy will tell you, because Andy is often the person who updates these tables, that they're shifting at such a rate. There's new rates, better rates coming out all the time. Whereas previously when we updated these tables, they'd almost be the same week in, week out.
Yeah, there was a time when we were updating these tables and it was same old, same old. It was looking at the same rates offered by the same banks and providers, but now it's a changing world. Every week we're looking across, and where we listed, say, top 5 products, I would say week in, week out now, we're changing 3 or 4 of those top 5 every week. So it's well worth checking those out because it's changing quickly.
And of course, we're talking about a world, you go back a year ago, where the best rate you would get would be less than 1%. And if you're getting an easy access account, it would be almost meaningless what you would get on it. So the world has shifted. You need to be considering cash now. It's a viable option, particularly for people who aren't wanting to take risk. And if you put that in context with what's going on in other areas of investing, for example, with stock markets and bond markets struggling, of course, that can turn around. Cash is looking attractive now. And of course, when the Bank of England and other central banks globally seem to be hell-bent on raising interest rates, and that seems to be the direction of travel, at least for now, then saving rates are likely to continue to move higher for a time. And now we're looking at the best rates for a decade. So the message of this podcast is to unlearn a lot of what you've learned over recent history, over the last decade, for example, in particular, about key areas of your finances. It's time to tear up those conventional wisdoms and review your personal finances. So savings, you can get much better savings rates. If you've got money in savings, therefore shop around. Look at those best buy tables that we provided links to and we've talked about. But it's not only that, is that if you go back to June 2020, and it was episode 277 of this podcast, I talked about cash ladders, how to build a cash ladder. Now, it was a concept that at the time I was trying to help people to boost their savings rate. And it was where we were hoping that rates were going to start to pick up a bit. Now we're in a world where we're seeing savings rates pick up, that a cash ladder really comes into its own. So go back and listen to that podcast. We'll put a link in the show notes. But just to give you a brief overview, a cash ladder is a system whereby you divvy up your money that you've got. So let's say you've got £100,000. You might split it into 5 pots of £20,000. You might decide, rather than put the whole £100,000 away for 5 years to get that best savings rate that's out there, because you might want access to that money. Don't forget, if you access early, if you're allowed to, you'll lose the interest you've accrued. There will be penalties. You might decide to divide it into £20,000 pots, for example, and you might put £20,000 in a 5-year fixed bond, 20,000 in a 4-year, 20,000 in a 3-year, 20,000 in a 2-year, and 20,000 in a 1-year fixed bond. Now, I'm ignoring the money you've got in a cash buffer. I'm talking about your savings pot. What would happen is each year that you go along, money will mature. So the money you had in a 1-year savings bond will mature after 1 year. You would then lock that away for 5 years again. And what will happen in a world where interest rates are hopefully rising, you get that flexibility to be able to secure a potentially better rate if interest rates keep going up. So you get that money, you put it into a 5-year fixed bond. Then obviously 2 years into this project, the money you put in a 2-year bond now has matured. You get that out and you put it into another 5-year fixed bond. So you can see that every year you'll get some money come out of a fixed rate bond that you'd locked into previously, and then you can look at what the best rates are there and lock the money away again. And in that way, you can therefore get an average interest rate across all of your money, have flexibility to still be able to get access to it within a year, but take advantage if interest rates start to go up. So cash savings ladders, go back and listen to that podcast and I explain it more fully. This is a technique that is going to be attractive to people going forward. The other thing I want to point out is, for years now, I used to see people talk about, oh, what's the point in cash ISAs? There's no point having a cash ISA because you've got a savings rate. Because don't forget that everyone has a personal savings allowance. And now I say everyone, that technically isn't true. It depends on your marginal rate of income tax. So what happens is that as a starting point, everybody's allowed to earn £1,000 of interest without paying any tax on it. Now, this is separate to your personal allowance that's applied to your income tax, i.e. your earnings. Now, this allowance of £1,000 is only available to people whose highest rate of income tax is the basic rate tax, i.e. 20%. So they earn below £50,271. If you earn above that, you then only get £500 as your personal savings allowance. And if you pay the additional rate of tax, i.e. the 45% rate, then you don't get a personal savings allowance. I'll just add as a caveat to that, there is a starting rate for savings that exists of people who earn less than £17,570. they do get an additional band that's tapered. So once you earn above that amount, you don't get it anymore. But it does mean that some people can earn an additional £5,000 a year in interest tax-free. Now, we'll put a link to an article that explains how that works. But for a lot of people, that won't be applicable. So if you ask most people, they don't even realise that that starting rate for savings even exists. But the personal savings allowance does, and people should be aware of that. The issue is that people were saying, well, if you got that, what's the point of having a cash ISA? Because you don't get hardly any interest on your savings. You get less than 1%. So yeah, I have to have over £100,000 in my bank account for that to even be worthwhile bothering with. So I'm going to just stick with a savings account rather than have a cash ISA. And often cash ISA rates are worse than a bog standard savings account. And of course, in past podcasts, if you've regularly listened to this show, you'll know that I highlighted why cash ISAs would be good, because in the future, when rates rise, your money's in that tax efficient wrapper, and now you're going to start getting a better rate of return. Then none of that interest is going to be taxed, but you're still going to have your personal savings allowance, which is applicable to your savings account outside of a cash ISA. So the point is, cash ISAs now are worthwhile. There were people who started saying they weren't, they are, and that's why you put money in these wrappers, because you've got an allowance, £20,000 a year. You are limited to how much you can put in, so you need to just keep stuffing them for periods like this. Keep your money protected from the tax man. But the other thing I want to add is, if you do the maths of what I was talking about earlier, now 4% on savings, and it's going up, so we can get 4.5%. We'll probably very soon be getting 5% on some savings accounts. If you're getting 4%, you only need £25,000. And I say only because that's in comparison to the £100,000 you had to have before to breach that £1,000 a year savings allowance, which means you then start having to pay tax on some of your interest. So we've moved on to a world where we have to start realizing that there are going to be plenty of people. You might be saving for a house, for example, and have got a deposit that you are potentially liable to tax on your savings. And it's something you've never thought about. So the world has shifted. So people have to realize savings isn't like it was before. It's become attractive. There are things you can do to get even better rates. You do need to shop around, but you are going to likely to start paying tax. So you need to start planning for that. Right. I'm going to move on to mortgages now. So we've talked about mortgages recently on the podcast because everybody wants to know about them. What's happening. Now, I regularly do interest rate prediction videos which talk about the market's predictions of where the base rate's going in the future. And that's pretty key to most things in the mortgage market. The base rate obviously influences what happens to people who are on tracker rates or standard variable rates. That's much more direct. The current base rate obviously doesn't directly impact fixed rate deals because they're fixed, but even new fixed rate deals that come into the market, the way they're priced is based upon the funding that the mortgage companies can get. So that will be a combination through government schemes, through the market itself. But if you look at things like gilt yields, so yields are loans to the UK government, so they are things that pension funds invest in. People listening to this podcast will have invested in things like that via their funds that they're in. It's a similar thing to a treasury in the US, but this is the UK equivalent. If the yield on that goes up, so that's the return you can get from a loan to a government, which you think is going to pay back, then it corresponds that the rate of interest that's charged on a loan to you is going to be higher than that. It just makes sense. That's the way finance works. So you can see if we start seeing gilt yields rocket, we see mortgage fixed rate products start to rise, and also a combination with that base rate being expected to rise because of rising inflation, then that's why the market starts to price in higher interest rates. Now, at the moment, the market is now pricing in the base rate to go up to at least 5.5% by the second quarter of next year. So that's 2023. Like I say, I update the videos all the time. So if you listen to this in the future, go and check out the YouTube videos that I do. But also we've got an article on our site titled "Remortgaging is now the right time to fix and for how long?" Now in that article, I update a chart that shows the predicted path for the Bank of England base rate over the next 5 years. And that's based upon the market's predictions, and that's based upon swap rates. You don't need to really understand how it works, but that chart shows you what the latest prediction in the market is. And of course, that influences the prices of things like mortgage rates. So make sure you check that out. But that is why we're now seeing mortgage rates for fixed term mortgages hit 5 and 6%. Go back a year ago, you were getting rates of 1, maybe 2%. It depends on your loan to value ratio. So the more equity you have in your home, the better rates you get. But now people are looking at rates at the moment of 5 to 6%. And if the base rate keeps going where people think it is, then we could be looking at rates of north of 6, maybe 7%. And of course, some people who have a lower loan to value are already being quoted things much higher than that. And there was a lady who was, I think, on Question Time. She was trying to apply for a mortgage as a first time buyer. And rather than get a rate of 5% as she was looking at, she ended up getting one at 10%. Now, I don't know the details of that, but just shows you where we're going with mortgage rates. Now, with the base rate and gilt yields rising, then that obviously, as I said, influences mortgage rates. But why is that happening? So, of course, the interest rate at the Bank of England, so the base rate is going up because they're trying to quell inflation. But when Liz Truss and Kwasi Kwarteng decided to unleash their mini budget, if you've listened to the market update that I do, where I talk about what goes on in investment markets, that caused complete chaos, not just in the UK, but particularly in the UK, but also globally. Because what it did, they came out with these huge tax cuts. It was lauded as the biggest range of tax cuts in 50 years, but it would actually cost billions of pounds to implement. Now, the market doesn't know how they're going to fund that. And the problem is, if it's going to be funded by borrowing, so you do that via the gilt market, then just like anywhere else, if you had a friend who kept borrowing loads of money, you would be nervous about lending them even more because you're thinking you might not get your money back. And even if you did, or if a bank or something wanted to lend them money, they get charged a higher rate because there is that risk of default. That's what's happening in the UK. And the problem is that's spiraling out of control. And of course, the cost of all that borrowing to implement that starts to cause a problem, spooks the market. And so that's why gilt yields rose, and that's influenced the mortgage market. And of course, the mortgage market then closed down. So we had, I think, 40% of mortgages get pulled almost overnight. And so people were scrambling to try and find mortgages and fix them in fear, but there weren't any deals available. So one thing that people have to realise, everything you learned about the mortgage market in the last decade, you need to tear that up to a certain degree. We were at a historic low of 0.1% base rate. Will we ever go back there? Who's to say? But that came as a result of a financial crisis and a global pandemic. Now, this podcast, we always talked about how they were historic lows. They were unusual. The long-term average is around about 5%. So we're heading back towards the world that is a bit more normal in terms of where the base rate should be. So people think that they can just keep remortgaging, they're always going to get cheaper and cheaper rates. I think we're in a period where that might not be the case. Certainly anybody who's remortgaging in the next 12 months or who has already remortgaged are likely to see much higher rates. They're seeing their rate jump maybe from 1 and 2% up to 5 or 6%. Now, if you have a mortgage, £100,000 borrowed over 25 years, every 1% more on your mortgage rate adds around about £50 a month to your monthly repayment. So the mortgage market has changed. Deals are appearing and getting pulled very quickly. At the moment, the market is trying to reprice itself. The issue you have, people have to bear in mind, is that it's not just going to be that people come back to the market, this is lenders I'm talking about, and just give a really cheap rate. If they do that, what happens is that they get flooded with applicants and they get overwhelmed. So there will be a herding element to the rates that are on offer. So even if the funding levels improve for them, which means technically they could offer mortgages at a cheaper rate to you and I, they'll be nervous about doing it because A, the volatility that's going on in the economy and gilt markets and their financing, but also because they don't want to be swamped and not be able to deliver to their customers. So you'll get an element, there will be a lag. So things aren't going to get better really quickly, even if the Bank of England cuts rates. Let's say we have a recession. Of course, the Bank of England intervened in the gilt market, which perhaps slowed down some of the rises in gilt yields and therefore perhaps slowed down some of the rises we've seen in mortgage rates, but they've not stopped it. It's just slowing down something that seems to be almost inevitable. The thing is, as well, in days gone by, you could research the mortgage market yourself online. And although I always said get mortgage advice, you really should no matter what, because you can get better deals. The broker can find you a deal that you can actually get based on your circumstances and do a lot of the legwork for you. Now, because the deals are being pulled so frequently and there are few around, you're not going to be able to research and find the best deals. The lenders aren't updating their websites that quickly, and some of them are only lending to existing customers. What we've also seen is people now finally understanding some of the risks that are inherent in owning property. Now, we love property in this country, and we always talk about it as if it's this one-way route to riches. And obviously on the podcast, I talk about diversification, and people know that I don't subscribe to that idea that, yep, you just got to own bricks and mortar. The issue is that really you're leveraging your investment. In this country, we allow people to use borrowed money to invest in property. And the risk is that when interest rates rise like they are now, that can become unaffordable. So what we've seen is over the last decade is people will be able to build portfolios on artificially low interest rates because of the easy monetary policy from the Bank of England, for example. And now reality is starting to bite, and there are going to be some people who are going to be casualties of rising interest rates, are going to have to be false sellers. But it is something that people need to realize that there are risks. People are starting to see some of the risks that they've largely ignored because they've not seen it for a long time. They are still there. I'm going to just quickly jump over to investing just for a second before I come back to mortgages again. On investing, people are now starting to realize that bonds are not the haven that they perhaps thought. So with anything, you've got to understand the risks. You've got to understand the period when they can perform badly, and that's when interest rates go up. And so bonds have been doing dismally in 2022. They're in a bear market, which means that most indices related to bonds have tumbled. And so if you invested in gilts, for example, you will be down way more than 20%. So again, always look at the risks, not just the potential reward. And I think people are learning that who previously had either ignored or hadn't appreciated it. Now, going back to mortgages, I think people are going to start focusing more on the early repayment charge because there are a lot of people trying to get out of their mortgages now to secure a new fixed deal. So their mortgage might be running out in the next year, but they're paying these early repayment charges, panicking because they're worried about how high interest rates could go because we're all much more leveraged, i.e. we have bigger mortgages than years gone by. Just as an aside, people talk about, in the early 90s, we had the Bank of England base rate at double digits, okay? And you don't know what it's like because it was really painful then. There's an interesting graph that's been shared about the strain that mortgages are placing on people's finances. And if you look at it as a percentage of their income, for example, their household income, the strain now is almost equivalent to what it was when interest rates were at those double-digit levels. And that's because people have bigger mortgages now than they did back then. And that's all because obviously lending got much easier over time, all the way through the financial crisis, right up to now. So when you have a large mortgage, then any movement in interest rates has a much higher impact. So getting towards 6% on the base rate at the Bank of England, it will be equivalent to what people experience in terms of the pain on their finances as back in those days of the double-digit Bank of England base rate. So that will be something that the Bank of England will be aware of. So going back to that early repayment charge, I think people will start looking at what their early repayment charge is, because before people just thought, I just want to get a mortgage and whatever cheapest, what's the rate? Now they're going to look at other features of their mortgage, including whether they can take payment holidays and also whether they can overpay. Now, coming on to overpayments, this is an interesting topic. We did touch upon it on the podcast earlier in the year. So that's podcast 320. And again, we'll put links in the show notes. That was about how to pay off your mortgage faster. And we looked at overpayments and we explored the idea of how that works and how it means that you pay off your mortgage more quickly, but you also pay a lot less interest. I won't go over that now because I'm conscious I'm talking a lot and this podcast will be quite long, but go back to that episode. You can find out the details. But the rule of thumb broadly about whether it's worth overpaying your mortgage versus doing something else, i.e. putting it in a savings account, is that if the savings rate or investment rate, we'll say savings rate because investments aren't in any way guaranteed, but if your savings rate that you could get at a bank was higher than your mortgage rate, then you were better off saving. If the mortgage rate that you're paying was greater than your savings rate, then you were better off overpaying your mortgage. Now, of course, go back the last decade, saving rates have been dismal and mortgage rates have been pretty low, but they've always been that much higher than savings rates. And so generally for most people, it meant that overpaying made sense. Now we're in a world where if you are on a long-term fixed already, so you're on a fixed rate mortgage and you've locked into a low rate, but now you've got these higher rates that I talked about earlier available at banks, you are shifting into the world where saving becomes more attractive than necessarily overpaying your mortgage, because you can earn more than you are saving on the overpayment. So we'll link to a calculator that you can play with the numbers yourself and work out what will be best over the long term, because you also have to bear in mind the taxation. So I talked earlier about taxation on savings. People weren't bothered about that before. They will start to be bothered about it now. But of course, savings are potentially taxable. But obviously, if you pay off your mortgage, there's no tax on that. So you benefit that completely, i.e. gross. So to give you some numbers, if you've got a 2% mortgage rate, then if you don't pay any tax at all on your savings, then you only need to find a savings rate that's at least 2%. And once you do, you find one more than 2%, you're better off. If you're a basic rate taxpayer, then you need to find a savings rate of 2.5%. If you are a higher rate income taxpayer, so you pay the 40% rate of income tax on your top end of your earnings, you need to find a savings rate of 3.3%. If you are one of those people who pay the 45% rate of tax, so you earn over £150,000, you need a savings rate of 3.6%. So those are the numbers you've got to look out for. If you are someone who is now just fixed onto a mortgage with 5% interest rate, if you're a non-taxpayer, so you're not going to be paying tax on any of your savings, then you need to find a savings account that's paying over 5%. Now, if you're somebody who has to pay tax at the basic rate on any of your savings, then you need to find a savings account that pays 6.3%. Higher rate taxpayers, if your savings are going to incur a higher rate of tax, the 40%, you need to find an 8.3% interest on your savings. And if you pay the top whack of income tax on your savings, then you need to find a savings account that gives you 9.1% a year. Now, of course, these numbers I've quoted for the savings accounts are before tax, but what you can see is the higher your interest rate goes on your mortgage, then you are likely to be better overpaying. So it means that for one group of people, the people on long-term fixes already, then actually saving is starting to become more attractive, whereas there are people now who perhaps weren't thinking about overpaying are definitely going to be better off overpaying their mortgage. And they're all going to be feeling the pinch because they are obviously got large mortgages probably as well. So you want to bring down the amount of debt you have in a world where interest rates are rising. As a throwaway, what would be quite interesting as well is that people are starting to look at the idea of using some of the money when they remortgage, if they borrow a bit more, to do energy efficient changes to their house to try and somehow reduce their energy bills every year. So I'm going to leave mortgages behind now because I could probably talk about that all day. Now, pensions. This is something that is fundamentally different. Pension annuities have been one of those things that have almost been forgotten. We talked about it on the podcast. We did a podcast episode actually last year, 348, which talked about when to buy an annuity because there were times where it still remained attractive. Now, when gilt yields fall, as I talked about before, this is impacting lots of areas of personal finance that you probably never realised, but annuity rates are one of those other areas it impacts. Because of the way annuities are funded by the insurer, when gilt yields rise, it means annuity rates can rise. So this is great news again for pensioners. So if you've got lots of savings, no mortgage, and you've got a pension, then there's good news all round by what's happening. And to highlight what's happened, the level of income you can now get from an annuity has jumped by over 50% since the start of 2022. That's incredible. So just to remind people, an annuity is where you effectively get your personal pension pot, you take it to an insurer and you go, here's my lump sum. And they go, thank you very much, Damien. Here's a guaranteed income until the day you die. Now, you can tailor it and have certain guarantees, or you could have a spouse's benefit as well, which changes the level of income. But broadly, that's how it works. You can also get improved rates, better than normal rates, if you've got impaired health. So you might have a health issue that means that you've got a shorter life expectancy. It's the one time in life having a poor health is actually good news. Not that you're going to die, but you'll get a bigger income because the insurer can afford to give you more, because they're statistically working out across their whole book of annuities. They will look at that and think that the liability is going to be shorter in terms of years. Now, to give you an example, at the start of the year, a 65-year-old could give £100,000 to a pension provider, and they would have got £4,521 a year. So that's a annuity rate of 4.5%. Fast forward to today, and they would get £6,873 a year. That is an increase of 52%. And that's before we've even talked about impaired life or enhanced annuity rates. So that is unbelievable. If you think about it, if you were in drawdown, so if you kept your pension invested, did buy an annuity, and you used the investments within that pension to provide an income, assuming you didn't change the strategy, that means you'd need a pension pot that was 50% bigger to provide this uplift in income if you weren't taking any more risk, if that makes sense. So that is a huge increase. Now, annuity rates have been low for a long period of time. What this means now is, from a planning point of view, if you're approaching retirement or in retirement, you will want to be having conversations with a financial advisor, for example, and looking at the ability to buy an annuity. It's a viable option now. And if you want an inflation-linked annuity, the improvement in the rate has been a whopping 77% increase in just 9 months. And don't forget, it isn't an all or nothing discussion. You don't have to use your whole pension pot to buy an annuity. You can use part of your pension pot to buy guaranteed income via an annuity, or you could do it in stages throughout your retirement, which is what we talked about in that podcast episode 348. So what we're going to hear now is a lot more talk about annuities, and you should be talking about annuities more, thinking about them more going forward in this new world, if it continues as it is for now. A few final points on this. It will open up the opportunity for some people who think, do you know what, I'm retiring at age, say, 57. I don't get my state pension for 10 years. They could potentially buy a short-term annuity. You can buy a 10-year fixed term annuity, for example, to provide a guaranteed income until the point they get their state pension. So they are effectively using their pension to sort of fill that gap for a period of time. This sort of financial planning will come into play now, whereas before it wasn't very attractive. And don't forget, depending on how and when you do it and what type of pension that you have, it can be possible to take an annuity without triggering the money purchase annual allowance. So that would mean that you could potentially still contribute £40,000 or up to £40,000 a year into a pension and get tax relief. So all of these things are interesting. You're also going to get people talk about purchased life annuities, which is where you buy an annuity outside of a pension pot. That's something else I won't dwell on, but it's an interesting topic, maybe something I'll come back to in the future. And also annuities where you have those added benefits. Maybe you have a spouse or partner payout that could be 100% or 50% of the pension you receive. So when you die, they get a benefit, because normally what happens if you buy a single life annuity, then when you die, the payment stops. So if you bought an annuity, you die the next day, all your money's gone, then the insurer, pension provider keeps it and the payments stop. But you can buy annuities that have those benefits for people like your spouse. It does reduce the amount that you get a year, but with the uptick in annuity rates, this is all starting to look a lot more attractive. So I've covered a lot there, and I just want to finish on one other final thing to do with investing. I touched upon the bond market and people starting to realize that, yep, bonds aren't infallible. And it also leads on to the idea that people who talk about Vanguard, if you look at now, the Vanguard's performance has been terrible year to date. If you look at the life strategy funds, it's down 13.27% this year. As I look at it, I keep hearing people going, oh, my Vanguard fund's doing terribly. That just shows you need to understand, as I did on a previous podcast, what it invests in, because when treasuries collapse, that's obviously dragged them down. By contrast, my portfolio, 50k portfolio, I run on 80/20 investor. It's not immune to stock market falls. After all, bond and equity markets are down more than 20% each. My portfolio's down 6.5% year to date, which I have to say I'm pretty pleased with. It means that I'm outperforming fund managers, discretionary fund managers, and that's because I'm investing in all sorts of different assets. So if you want to have a look at 80/20 investor, don't forget you can have a free trial. So there's a bit of a plug there, but it highlights again, you need to think about managing risk. And what was the conventional bond equity portfolio isn't currently working in this environment. So you need to start to think of diversifying beyond those assets. So there you go, Andy. I know I've just talked at you for that whole show. I just had so much to get out there that we've been talking about in the last couple of weeks that I've just kind of dumped. So if anybody has any questions on any of that or other things they want me to talk about, then please do send in an email to the show or contact us on social media, because we are in a very fluid environment, but there's a lot that's changed now. And for some people, that is going to present some really positive opportunities. It's not all negative.
Excellent stuff. And Damien, please don't apologise for talking at me. I think in a way you're just making up for missing out on the podcast last week. And I can see you're getting animated. For those of you who can't see Damien as I can, there are arms being raised all over the place as he's making his passionate plea. This is what Damien does. And like I say, Damien, never apologise.
Yeah, on that, don't forget that I'm doing a panel event in London on the 26th of October. We'll put a link to the event where you can register in the show notes and on the website. Do please come down. It'll be great to meet people. You'll see me getting animated and passionate. And I haven't met anybody really from the show for a number of years now because of the pandemic. It'd be great if most of the audience were people who listen to Money to the Masses. And also, I've given up going to Tottenham, I've realised, that night in the Champions League. So it'll be much more exciting for me to see a whole bunch of Money to the Masses listeners, and it would make my day.
Okay, so if you want to get in touch with Damien, you can do so in the usual way. We covered it earlier, but it's Damien at moneytothemasses.com. Andy, if you want to contact me, Andy at moneytothemasses.com. And of course, you've heard how passionate Damien is about the subject of money. So why don't you go over and thank him and give us a review in the usual way on your podcast platform of choice. And if we read it out in a future podcast, then you may earn yourself a coveted Money to the Masses mug. Okay, so that's it. We're done for this week, Damien. Until next time.
Until next time.